What does a forensic accountant do?
So forensic just means suitable for a court of law. So if you're working on something and it might end up in court, if it's especially accounting related, and it might end up in court, whether you're suing someone or you might have to sue an employee for stealing from you, or you might have to sue a business partner. That's what forensic accounting is.
Why would a business owner ever need a forensic accountant?
So a lot of times you're looking at financials high level. So you see what your financial statements say, but if you really want to know down in the nitty gritty of what's happening with your business, especially if you see some kind of downturn, you see your expenses go up, you're losing money, and you start to ask yourself, why are we losing money? A lot of times too, you may have a business owner who's passive, or they're more involved with the operations and not the accounting, and they may not be getting the answers they want from their business partners. So they could pull a forensic accountant in to say, hey, what's really happening here? Because I see we're losing money, my distributions are down, and I want to get to the bottom of it. And the benefit of going to a forensic accountant is forensic accountant knows what it's going to take for whatever the outcome is to hold up in court, versus just talking to an auditor or a general accountant. They can tell you, here's what your financials are telling you, but we go under the hood and say, well, here's what's happening underneath that's causing your financials to look like this.
So, Jack, this is kind of the exciting stuff for me, talking to a forensic accountant here. You know, when we're doing transactions, oftentimes we rely on what the other party gives us as far as financial statements. But
Right.
What's interesting here is that financial statements, when somebody looks at them, we'll just assume that the underlying data is accurate, right? And then if we come across something later on post-transaction, then we go into litigation potentially and try to find out. But here, you could hire a forensic accountant to go in there before the transaction and take a deeper look, right? So when you're looking at financial statements, a business owner has called you and said, hey, I'm thinking about buying this company, and I want you to go under the hood. Let me know if these numbers hold up. What are some of the first few things you're looking for in your exam?
Yeah, so I'm going to get the general ledger. If they can't give me full access to the accounting system so I can run my own statements, I'm at least going to get a general ledger, and I'm going to get all their bank statements. And if they use business credit cards, their credit card statements, because I want to be able to dig down and say, where's the cash coming from and where is it going to? Because that's where really, you can have a lot of other accounting entries, but at the end of the day, your profits are going to be based on the money that came in and then the money that went out. So that's the number one place I'm going to look at. I'll, of course, look at some of those high-level accounting statements, your balance sheet and income statement, just to get a feel for what kind of business is this? What do they have on their books? What do they operate? Do they have a lot of fixed assets, a lot of inventory, a lot of payables, et cetera? So I can get a general feel for how I think, what kind of entries I will expect to see when I dig into the general ledger. Then when I'm looking at the actual journal entries, that gives me a sense of, hey, here's the kind of things I'm expecting to see. Do I see it like that? Or do I start seeing things that are different than what I would expect to see based on the nature of the business?
What are some interesting things that you've found when you've gone down this rabbit hole?
So, for instance, there was one client who was actually post due diligence, we'll say. So I was hired after the fact, but it was after an acquisition. And, I'm looking at the financials, and the first things that jumped to me were, wow, we got a massive amount of goodwill on the books and it keeps growing. I don't know what's up with that, but I'll look into see how that keeps growing. There was a big amount of, sometimes I see a mass amount of inventory, where there was one business where I was looking at it and saying, why do their inventory always grows? It never goes down. And in both of those cases, it was bad accounting that was causing it. When you look at the underlying entries and say, wow, they're booking these entries to goodwill, but really they shouldn't be hitting goodwill. They should be hitting something else, not goodwill, but instead it's bringing up the value of the balance sheet. In the inventory example, it was a business where the gentleman says, hey, my spouse does my accounting for me, but we're divorcing, and I think there's something wrong with the books. My tax accountant says I owe $50,000, but there's no way I owe $50,000. There's not $50,000 in the account. And when I was looking at his books, I was going over some things, and I told him, hey, so do you have, $250,000 of inventory? And he says, no, I don't have any inventory. And when I was showing him, hey, here's how these things were recorded, they're going to inventory instead of an expense. So his income was being boosted up. His tax accountant is taking it at face value. His balance sheet looks really good, but there was no inventory there. So we went over it, made the adjustment. I talked to his tax accountant, 50,000 tax debt went away. after I dug down into the entries and said, well, here's what's really happening that's causing these things on your financials. But a lot of people will look at it and just not really think about, hey, how is this impacting my financial position?
Yeah, and one of the situations we encounter, especially working with lower middle market companies, is you have the owner of the business who, they were on the line before, they were working in the business, but now they've graduated to become the CEO. Let's just call it what it is. And they've relied on complete strangers, obviously their employees that they trust, to run the company. But oftentimes they have no accounting background. I'm talking about the business owner here. So they just take everything at face value. And oftentimes they're making business decisions based on the numbers that are flowing up for them. So how does a forensic accountant potentially come in? How can they come in and help this business owner to kind of get a second look to say, hey, are these numbers accurate? Is there something else I need to be looking into? Is my executive team the right team? Are they leading this company the right way? What are some of the things that a forensic accountant can do to help in that situation?
Yeah, and I'll say too, in a lot of these companies, they're not big enough to need an auditor yet. They haven't had to get any outside debt. A bank hasn't asked them to get an audit. So no one's looked at their books. So they're just doing their accounting how they best feel like they should be doing it. And there's no one who's looked at it and said, hey, you need to do this a little differently. So part of what I do when I go in is say, start to look at things that I see but the end goal is to put it in a bucket of, is this just wrong? Is this just bad accounting? Or did someone benefit from this? Is this an intentional act to where someone could benefit from this? That's where you go into, hey, do we need to help train your accountants to do a better job? Or is there something going on where you may need to file a lawsuit for some kind of internal theft? So really having that, mindset of looking at it to say, let me just see things that are wrong. How could you improve? But then also looking at it with that mindset of, if I see something wrong, I want to be able to tell you about it. So you not only fix mistakes, but also be aware of ways that you might be cheated.
Yeah. So you mentioned theft. We're talking about theft maybe by an employee. And I don't know if this is a question, more a legal question or more a forensic accounting question, but you go down this path and you discover some employee dishonesty, and maybe you got some kind of a bond to take care of that, but it could always lead to bigger problems. But have you encountered situations where you've gone in and you've discovered employee theft?
Absolutely. And a lot of times someone will come to me and say, hey, I think something's going on. I don't think it's that big a deal. Sometimes one business particular came and said, hey, we know about $40,000 of theft. The employee fessed up to it. We just want you to go in and see if you see anything else happening, anything else beyond that. At the end of the day, when we went in and started digging into the books, mind you, this was a small medical practice. No one was looking into the books except for the perpetrator. At the end of the day, it turned out a 10-year fraud that totaled about $2.8 million, just
Wow.
from what we could prove as slam dunk fraud. There was other things that we could say, hey, these are maybe other benefits, but there was a lot of slam dunk fraudulent transactions that we could point to and say, this person absolutely benefited from all of this to the tune of $2.8 million. Meanwhile, they were willing to pay back $40,000 to make it all go away and try to keep their employment. So that's the kind of thing, though, where the business owner's in that dilemma of, I want this problem to go away. They're embarrassed someone's stealing from them. They could just take the employee's word for it. Oftentimes it's a long trusted employee. So they want to keep that person. They're thinking, oh, there's no way this person would have stolen, $2 million from me. But then after the fact, when you begin to give them all that evidence, they're in a different phase of, wow, I was really betrayed by this person. But you need to go through that process to have all the cards to then be able to play the best hand or make the best decision for your business.
Yeah. So, last time we had a business litigator on the show, and we were talking about basically figuring out, the economics of lawsuits. And one area that I found very interesting is when they're doing the cost benefit analysis, they're basically going off of what they know, not necessarily what there is. And how does a forensic accountant come into play in litigation cases where someone's getting ready to go to litigation? How can you help a business owner there?
Yeah, so I would always wish that on any commercial litigation case that we're brought in early on. So even pre-litigation, I work with a lot of clients directly, and they say, hey, I think I have an issue going on. By the time they're done with me, they have an idea of, hey, I've got this big of a problem. So then when they're ready to go to their attorney, they have that information up front to say, hey, I've got $1 million problem. Here's some preliminary information that I have on what's going on. And it's done in a way where it's going to, with that cognizance of here's what we need to hold up in court, rather than just, hey, I think I've been damaged by $1 million. You go to your attorney, but then by the time you get a forensic accountant involved, you realize, wow, this is only a $50,000 true damage problem. So the big benefit is knowing that real number up front on what could I get if I invest the money in the legal process, what could I get as a result of it? And if you have a forensic accountant involved early on, aside from just any regular accountant, they know what it takes to have that damage model hold up in court, and they can be honest with you and say, hey, your case is really only worth X amount, ballpark. So before you invest more money in this process, just keep that in mind. Or if you go to mediation and they tell you anything above this number, that's probably more than what your case may be worth based on what we're seeing in this initial analysis. So a lot of benefit in just being able to guide your case and make the best decisions as a business owner if you invest a little bit of that money up front to get a clear understanding of the dollars.
Yeah, and we had a guest here the other day from a CPA firm talking about partnerships where, if you're the passive partner, let's say, just obviously you're entitled to look at the financial statements and to get copies of it. And if you do that, that's great, but it doesn't really give you the level of detail that we're talking about now. Do you find cases where business partners come in and hire forensic accountants to say, hey, these are the, here are the K1s I'm getting. Here are the financial statements, but can you take a look under the hood? Does that ever happen?
Yeah, I've talked to some prospects last week where it's just that situation where it's a minority investor and they say, hey, I'm waiting to get my K1s, but I'm not getting the financial information I'm trying to get that I'm asking for. And most of these partnership agreements have some kind of audit rights where you can ask for an accounting and you're entitled to those books and records, to review those books and records. So a lot of times that's what happens. They'll point to that. If the other party isn't being forthcoming and saying, hey, here's all the books, then they can go through an attorney to invoke those audit rights and then get a copy of the books, bank statements and all that. So then a forensic accountant can go in and say, okay, now we're seeing all the detail of why your distributions are down, why your K1 is low, because here's what the books are showing and here's what's causing the books to show those depressed numbers.
Well, let's also turn to a different type of partnership, which is your spouse. And a lot of these business owners, we talk about mom and pop places, but a lot of times you'll have a business, someone's kind of the face, but really it's a married couple running the business. Someone's the front face and someone's in the back office. And, as we know, a lot of the marriages, they'll fall apart, and then you have a business to go figure out, who's going to take over, whose business is going to be, how are we going to split it up? Do you get involved in those processes and give us a sense of, how they go and how a forensic accountant provides value for those? Yeah,
I do get involved with those. And what happens, a couple of scenarios. One of them is, you may have a spouse who's not as involved as the other spouse, and they say, hey, I'm entitled to half of the value of that business in the community estate. When we're getting all our assets together and saying, hey, I get half of this, I'm entitled to half of that business. So you'll have to get a valuation done for the business to say, is this business worth $1 million, $500,000, $2 million? And a forensic accountant can come in to look at all of the underlying detail within that business's financials. Because if there's any personal activity running through that business, or in situation when there is some kind of infidelity, if that's being financed through a business, that's going to depress the value of the business, bring down the valuation of that business, and in effect, bring down the half that goes to the other spouse. So that's a good situation where a forensic accountant can come in and say, hey, I know you have to value this business, but let's take a look and make sure that there is nothing going on that would hurt one side versus the other or depress the value of this business.
So I want to touch on that real quick. So divorce cases, and I've seen this, where they get an outside valuation company, and I don't want to give any names, but let's say names that we recognize. They come in and they present this nice report. They say, here's the value of the business based on market research or maybe a discounted cash flow model or whatever they use. But what I'm hearing you say, and this is my suspicion, they're not really looking under the hood, are they? They're just taking everything at face value.
That's right. And they don't, per their standards, they don't have to look under the hood. And that's why a lot of times evaluation would be done And then, it's almost like if you're the person who, let's say if you're the party who did some inappropriate things out of the business, and you're the primary person involved with the business, and evaluation's done, you're not going to say, hey, by the way, you need to make all these restatements and adjustments before you run your valuation because here's all the stuff I was doing in the business. They're going to run a valuation. The valuation will say, oh yeah, your business is worth $5 million. Then the other side is going to hire a valuation, someone to do evaluation as well. So now when that second valuation is done, that's when they should hire a forensic accountant as well to look under the hood to say, hey, is there anything that's depressing the value of this valuation? So then the second valuation analyst has something else to rely on to say, hey, I'm relying on this forensic accountant who says they see all of these things. If I take their opinions and adjust the financials based on that, here's what the value of the business is.
Yeah. So you said something very, very interesting. You said depending on the standards. And this is a conversation that I want to have with both you, Jack, and you, Rubik, specifically in regards to a client says, okay, let's just get the valuation done, or let's just get an audit done, and I want to pay the least amount of money. And then they'll go to the accountant, they go to the expert, and they'll say, well, if we use this standard, here's how much it'll cost. And someone will say, well, that's good enough. But good enough in this case hurts them, right? If we're using a standard, for example, limited scope valuations, right? It's limited in scope. So what you're getting isn't necessarily everything. And in the case that you just described, if we got a dispute between a couple that's divorcing, and you have the passive spouse who's basically taking at word value the auditor's report or the valuation report, they're not really getting a fair shake here, are they? So from a business owner's perspective, how do you balance get it done on the cheap versus get it done on the, get it done right?
Yeah, and that's where there could be immense value in having, some kind of consulting forensic accounting work done to say, hey, I want to make sure if there's anything major that you see, spend, for me, if I say, hey, within $5,000 to $10,000, I can scope something out that's beneficial. It may not be everything you want to see, but I try to be able to give value in some way to say, hey, you don't have to bet the farm on this. You don't have to spend 50 grand to get an answer, but spend a little bit and start getting a little bit of an answer. And that'll help start to let you see, hey, do I need to invest more into getting the truth into what's going on with the financials? Or through this preliminary analysis, if nothing comes up that's questionable, maybe I get that closure. I can go into the valuation now with that comfort of, okay, I don't think there's anything really obvious or really huge going on based on this initial review of this information. I'm going to now trust the financials at face value. But if that exercise shows, hey, here's 5 areas of concern, then you have a lot of digging to do, because then the more you dig, the more that could directly impact the value of your business and the overall judgment.
Yeah, I mean, these appraisals, talking about appraisals, they really anchor negotiations and the numbers around them. And because it is just some expert coming in and saying, this is the value. And if it's hard to sit there and dispute it. So to have somebody to come in and help, try to find in the nitty gritty that could really swing those numbers is all of a sudden going to really affect somebody's ability to negotiate a better deal. Or even if you just care about the truth, I want to know the truth. I want to be fair, but I want to get the right number. Those appraisals really kind of dictate a lot of the negotiation.
All right, I'm going to put you on the spot here, Jack. So let's say we got a client, we're on the sell side, and the buyer side comes in the negotiation there, they ask for, they bring in a forensic accountant and they want to get access to really deep data. Is that all of a sudden changing our position as a seller in what we're going to ask for and what we're going to negotiate? Does that put us in a weaker spot if we know these guys are coming in and they're, going to go really deep and into the detail?
So, I mean, I would, from a legal standpoint, the answer is no. I mean, we want to, in an M&A deal, especially from the seller side, we want to get all the skeletons out. As your attorney, I'm trying to get those out, because what we want to avoid is a lawsuit after closing. So it's a lot easier for us to deal with the problem and figure out a solution before we close. And we go through this whole process of making disclosures um, before we close, and every seller hates going through it. You have to dig through all these details, and present them in the agreement, disclosing all these different things that could be an issue. But in a lot of ways, it's good to get it out in the open before closing, because after closing, you're going to hopefully have a lot of money in your pocket. You have a lot of plans for it, and you don't want to necessarily get a claim later that says, well, you didn't disclose this to us, and now you owe us all this money that we paid you.
Yeah. And so do you find that, is it mostly buyers that are hiring forensic accountants to look at businesses, or is it the seller that's looking at it to make sure that when they go to negotiating table that they're asking for the right price and not wasting your time, or does it not matter?
Well, so I'll say historically, it's nobody hiring forensic accountants because they're relying overly on their accountants or whoever does a quality of earnings report for them. They're not taking that next step. I've gotten involved more so on the buy side where a purchase has happened and now there's some buyer's remorse. And then we're trying to help them figure out, hey, what went wrong? So in the situation I mentioned where, hey, all of a sudden I look at the books and there's a bunch of goodwill that's just increasing on the balance sheet. That was a good example of that, where it was a year or so after the purchase and a lot of stuff was just getting booked to goodwill instead of hitting the P&L, instead of being an expense. And so that was looking like, hey, the value of our balance sheet, the value of our business is increasing, our equity is going up, whereas really there should have been a lot of your profits going down. So it's something where it could benefit both sides. If you're on the sell side, as Jack said, you want to make sure that there's no skeletons in the closet. The actual seller may say, oh yeah, I think everything's fine. But as the attorneys involved, with the deal, they want to make sure, hey, is there anything that's going to surprise us so we're aware of it and can plan for it? But then really on the buy side too, you're taking on a set of books. So what is in that books? It's worth investing that money to know, hey, is there anything that I'm missing here through what I'm seeing on the books or what the seller is telling me? So a lot of value in both sides. So a good way to cover yourself on the seller side to make sure, hey, is there anything that's going to hop out that then we don't want the buyer to find and try to use to negotiate against us to get a discount. But then on the buy side too, hey, what is jumping out that we can see now before the deal closes and use that to our advantage to where we deal with it now versus, after the transaction occurs.
Yeah. You mentioned quality of earnings. Can you touch on that a little bit just so we're on the same page? When someone's doing a quality of earnings report, what are they doing?
So they're looking at the financials. They may look at certain areas of it depending on the type of business to say, hey, based on it's a manufacturing business, so I'm going to look at your inventory, your equipment, your cost of goods sold and everything. And I'm going to focus on some of those areas because of the nature of this business. So they're going to give an opinion on the strength of the financials, and they may do some digging in some areas, but they're not necessarily looking at everything as far as, hey, what could be going wrong anywhere in the financials.
And then, in terms of kind of where the quality of earnings kind of plays in a M&A context is usually, two parties are coming together. They've seen some financial statements, the buyer's getting excited, and, we've already kind of circling on what the purchase's price is going to be. And then at that phase, you usually will go through a quality of earnings, and that's going to try to, for the buyer, firm up whether that purchase price makes sense for them or not. Because as a seller, we're going in there and saying, we want X, this is our purchase price. We think it's worth that much. And the buyer might say, yeah, if you're right, if your financial statements, hold up in this quality of earnings report, that sounds right. But in the deals we work on, we're not holding our breath until we get through the quality of earnings report.
Yeah. And correct me if I'm wrong, but a lot of these accounting firms, they don't necessarily focus on forensic accounting, right? This is a specialty.
For sure. Yeah. I mean, audit tax is the bread and butter business. And now more and more accounting firms are offering the monthly accounting or bookkeeping services. And so they're outsourcing, companies are able to outsource their accounting to accounting firms to handle that. But the forensic is very much a specialty service. And it's a lot of bigger firms may have a forensic practice in them. And there's a fair amount of smaller practitioners, but most firms, I'd say, that do just audit tax work are not necessarily going to have people that do that. And if you go to a traditional audit tax accountant and ask them to do forensic accounting work, then you're not going to get a good result. So a good example of that is whenever I've in the past, I've testified as an expert witness in commercial damages cases. And it's always exciting when you do your report and then you wait and see, okay, who's the accountant on the other side? Because each party, the plaintiff is suing a defendant, plaintiff hires an attorney, attorney hires an accountant, and then defendant hires their attorney hires their accountant. And so the attorneys are duking it out, but then the accountants are duking it out on the numbers. And whenever we get to see, hey, who's the accountant on the other side? That's when it's like, ooh, is this a reputable person who we've been up against or is well known in the industry? And sometimes, I've seen where it's just, hey, it's a small town accounting firm. You go to their website, they just do tax services, and they're put in this situation to be an expert. Yeah. Those are those situations where I know we're going to win, because this person doesn't know what they're doing. They know some accounting, but they don't know forensic accounting. So that's a big flaw then that they'll run into, and it's going to hurt their clients when their clients choose to hire just a regular accountant for that kind of thing.
Yeah. Speaking of being an expert witness, so funny story here. One time I showed up as an expert witness, and the day of my the day of the trial, or the day I was supposed to be on the stand, the opposing counsel looked at me, and within about 10 minutes, I don't know what happened, they decided to settle. So that's my claim to fame as a expert witness. It was on a tax matter. But what's the craziest story you've seen in your line of work?
Oh man, one of the cases that's been my favorite of all time is it was a case involving bank fraud. And I was working on the civil side of the case, and the FBI got involved for a criminal side of the case. And so the firm I was working for at the time, we were working up the case, and then the civil side actually got settled. And after the fact, the FBI said, hey, we're still pursuing criminal charges. We want to use your work. And I was able to continue helping them with it. And, long story short, it was a cattle company, and the guy was just doing all kinds of stock market bets through the business. And it wasn't just cattle hedging. It was just all kinds of other things. And when I looked at the books, I was like, there's no way they should be debiting this and crediting that. Like, a lot of these things don't make sense. And so I got to go alongside of an FBI agent who was a gun-toting agent. I remember he was a history major, he told me, so he knew very little about the numbers. But it was great being able to go with him because I knew I was protected. And we'd be interviewing witnesses, whether it was a business owner or the controllers, and just getting down to the nitty-gritty of the financials, and me being able to go through that with them, and knowing that, hey, in this situation, even though you settled on the civil side, justice was still served, and that, there were criminal allegations brought, and the people ended up going to jail.
Did they end up using your work for free, or did they pay you, the feds?
Oh, well, so in that situation, I think there was a little bit of both. So we got paid a little bit, and then there was a little bit of pro bono, but, with the understanding from the firm of, hey, this is good experience, it's beneficial, and, it was a good case. We didn't want to leave them hanging there, especially when, we had a FBI agent who was a history major who couldn't exactly take over or adopt our work product at that point.
Yeah. So I'm glad we brought up the criminal side of things. So just to put everybody's mind to ease. So if you're hired by a business owner, a business or entity, and you uncover things that potentially are criminal in nature, you don't have a mandatory reporting duty, do you?
No, and really the things that I see in my work, it's I'm not going to see financial statement fraud. For instance, I'm most of the time working with private companies, so something like that wouldn't come up where you may have some obligation to say, hey, you're cheating the public, and if it's SEC filed financials. So yeah, I don't run into that.
But if you come across where an employee has been embezzling money, or like we talked about earlier, where you uncover things that outright fraud, again, you don't have a duty to report that employee, right?
To my client.
Yes, to your client, yes.
But I don't have a duty to report that to law enforcement or anything, because there's always, you can have civil remedies, criminal remedies. It's up to the client to decide that. At that point, I'll tell them, hey, talk to your attorney, because sometimes they'll say, oh yeah, we're going to go file a police report, and I'll tell them, look, a lot of times you may want to file a civil lawsuit too. because if you wait for law enforcement to handle this, it may take a long time, or they might say, hey, your case isn't big enough to move to the front of our list, and you're waiting a long time for some kind of remedy there. But then if you speak with a civil litigation attorney, they can get the ball rolling and get some action going straight up as well, from the get-go. So a lot of legal ramifications there. So at that point, though, you have the ammunition to go to your attorney and say, this is what is happening. This is what I'm seeing. What should I do?
Yeah.
Yeah. Sometimes the impulse, and I've seen this sometimes, is to, okay, we found an employee who's stealing from us. Let's go to the cops. And then now you realize you're just in the middle of a criminal case. And now the police officers or the prosecutors are coming to interview you. And you're a witness now to a criminal case. And it's like, you're sitting there and taking time out of your day, your business, to go and be interviewed by a prosecutor. Doesn't sound very fun either. So sometimes it's just the benefit is to find the problem and then just remove it and move on.
I'll say a good example too is that when you want to go that law enforcement route, if you have insurance, and sometimes your insurance policy will say, hey, if you want to file a claim for some kind of employee theft, we need a police report.
Right.
And so a forensic accountant can help the company say, how big of a problem do you have? Here's, we've got $100,000 in fraud, and they can look at their policy and see, okay, should we file a claim or not based on the volume of fraud here? At that point, they have an analysis they can, submit with that police report. So it really helps expedite that process to where, then, okay, I'm going to file a claim, and to file a claim, my carrier is requiring me, or to file an insurance claim, my carrier is requiring me to file a police report, and then you can do that. And really, it's the insurance company then is going to be on the hook for, hey, I'm going to try to recover from the actual perpetrator. They're going to file a lawsuit for a subrogation claim to say, well, we want to recover the money we paid out to the business on our policy, and that's their problem then. So you're getting paid for your claim, but then the insurance company's still going to go after the party at some point.
Yeah. So Jack, if we're on the buy side, we're definitely bringing a forensic accountant to make sure that the numbers that they're telling us is accurate, right?
Yeah. I mean, I think, we pre-closing or post-closing, a lot of times in these agreements, we're negotiating representations and warranties, and we've talked about those a lot.
Yeah.
And we're a lot of times, if there's kind of no specific thing motivating the specific drafting of representation, we're just trying to get to what we would call market. And that's just kind of what's commonly the give and take of a rep. And in the financial reps, you'll generally have a rep that says that they're complete and accurate. You'll have a rep that says it's consistent with historical accounting practices. Because a lot of these companies, they're not GAAP compliant. They don't have we were talking about this earlier, the audit history. And we might be in a situation where we have a rep, it's a common rep, but the seller's not in breach. And then the forensic accountant finds something. So to have somebody to come in on the front end and really kind of test the waters, we might not be able to get as a buyer a representation that, covers the universe, but we can certainly do the diligence to try to figure out if there's a problem.
Yeah. Getting back to those standards, I just thought of something. When they say this is the standard we use, and then you have to go basically research what that means. And oftentimes it'll say, we didn't verify what the business owner or the management told us. We just took their word for it. And at that point, basically, you're getting somebody to just say, yeah, we looked at, we just took their word for it. There's nothing else. And what I find really interesting is I remember taking a managerial accounting class, and they were talking about FASB and the rules. Mm-hmm. They're so obscure, right? It'll say, this means more than that and less than this. What are you talking about? So if I'm looking at financial statements, or if I'm looking at an auditor's report, and I'm reading the standards, and I go and I research what those standards are, how much weight do I give when the auditor, even though they got this auditing firm or CPA firm there that signed off on it, when they're basically saying, yeah, we just took management's word for this?
Mm-hmm. So a couple of comments there. That's why I like to look at cash, to be able to tell a business owner, here's where your money went, and not here's what FASB says, how you should record this. There's some businesses where, there's some complicated accounting around certain industries. Lease accounting has been a hot topic these past few years, where If a business has a lot of leases, then you're going to want to have someone with that lease accounting expertise to say, hey, are they looking at this correctly? Or do we need to restate something, based on this, how this company has been recording this? But a lot of times, you look at what's happening with the business on essentially a cash basis to say, hey, this is how the business is really doing. You mentioned, the standards. A lot of times I see language in even private companies where it says, oh yeah, the financials are supposed to be held in accordance with GAAP. But then you look at it, and like you said before, no one's holding GAAP financials. It's a private company. They don't have to. And so I'll see oftentimes in cases someone says, oh yeah, they gave us this audit. They're using the term audit very loosely, assuming that, well, I guess it's an audited financial, so it's in accordance with GAAP and whatnot. But there's 3 different levels of standards, even in assurance in accounting. You could get a compilation report, which it comes with a little cover letter that essentially says, hey, the client gave me all their information. I took it all at face value. I'm not giving any assurance that all of this is correct. I'm just making it look like a balance sheet and income statement. So that's a compilation, least level of assurance, 0 assurance. And then there's a review and then an audit. And so each step you get higher, you get some more assurance that, hey, an accountant's looking at more and more, but still they're following the standards and they're doing some sampling and they're not looking at 100% of the population. So although you get some of that coverage by following the standards and an auditor can say, hey, I'm planning my audit in accordance with these standards, that's all done so they can cover themselves too and say, well, I did what you asked me to do. But a lot of times the business may not know what they're really asking for. They get a compilation report, they give it to me and say, yeah, here's an audit. It's like it literally says on page 1, there's 0 assurance in these financials. It's just I took what they gave me and I'm regurgitating it to you in a cleaner format. But still people think that's a audited financial sometimes.
Yeah, appealing to higher authority, right? Look, the auditor signed off on this thing, but we have no idea what the level of assurances is. It reminds me of one time I had this professor tell me, if you're looking at financial statements, all the information isn't in these tabular formats. It's all in the footnotes.
Right.
Read the footnotes. That's where they're hiding everything, because nobody reads the footnotes. And if you look at any financial statement, you'll see hundreds of footnotes.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy. It does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.